So, as we mentioned here today, our topic is going to be around creating resilient supply chains in the new normal. And we'll actually be discussing the challenges facing supply chain groups such as COVID-19, low energy prices, trade tension. And we'll try to emphasize somewhat, some of the solutions and how industry is tackling these problems. As Robotic mentioned, we're fortunate to be joined by two prominent experts and practitioners in the field here. First, we have Bill Niddle, who is VP of Supply Chain Management at Cheniere Energy. Bill has spent the past 30 years in senior operations and planning positions at BP and prior to that at Amoco, and has even spent some time as an external consultant himself. Cheniere, of course, is the leading producer and exporter of LNG in the U.S., and Bill is actually currently leading their efforts to transform and digitalize procurement and supply chain. And as you can see from his bio, I guess we flipped off that page here, but from his bio, he's successfully done this a couple times in the past and won some awards for it as well. So he's a practitioner with some real-world experience. So thanks very much for joining, Bill.
Thank you.
And next we have from NC State University, we are joined by Distinguished Professor of Supply Chain Management, Robert Hanfield. Professor Hanfield is Executive Director of the NCSU Supply Chain Resource Cooperative, which is an industry think tank on supply chain best practices and issues. He's also authored several books on the subject and advised major corporations on these topics. Thanks very much for joining us, Robert.
Pleasure to be here today. Thank you.
All right, and last but not least, my name is Kareem Kayani. I'll be your moderator here today. I'm the Managing Director for EvaluServe's U.S. Energy and Supply Chain Practice. EvaluServe is a global consulting firm that delivers research, data analytics, and bespoke digital platforms. Of course, a key component to solving a lot of the issues we'll be talking about today is having the right knowledge and tools at your disposal, and that's really where we come in to help. So you should have a pretty well-rounded perspective here from all sides of the industry, and we're looking forward to taking your questions as well. So please write those in the Q&A box as we're going. We'll have a dedicated Q&A session at the end for about 20 minutes to make sure we address all of those. And if any are germane to the topic we're on at the moment, and I see them in time, I may pop those in here as well. So on to our first topic here, which is deriving the right balance between risk, cost, and supplier rationalization. We'll kind of go back and forth. Bill, we'll start with you on this one, and then Dr. Hanfield, you can start the next question. So basically, the new normal has seen major disruption in supply chains and cascading impacts on operations. What are the key trends that you're seeing with respect to the move from supplier risk management to value chain risk management?
Sure. So I've been in this business for over 30 years, and it's probably one of the most dynamic supply markets I've ever seen. Been heavily involved in low-cost sourcing in my previous life in China. So I've sourced from all different regions. And what I've seen is there's two big impacts on what's affecting us. Some of this is industry specific, but other of it has broader impacts. One is COVID-19 and what that's driven. The other major initiative is around the area of oil and gas capital expenditures are low, and I think capital expenditures in general across industries, and I'll let Rob speak to that rather than me, but it's having an impact on the businesses. And we see that happening in three areas. We work closely with EvaluServe on trying to keep our hand on these kind of things. There's a financial impact in the value chain. There's operational capabilities issues in the value chain and supply chain. And then obviously where it shifts from just individual suppliers to value chain or supply chain is they all have to buy feedstocks or raw materials, they all have to get services, and then they have to produce and deliver their product. And what we see is all three of those areas are now driving high degree of risk, and you have to monitor all those three dimensions of both the supply market and your suppliers within that supply market. If you don't, you're going to get caught off guard. It's not a monthly thing. It's what are the trends on a month-to-month basis. And so we started this about 4 months ago, and I think that is what shifts this, if you will, from I just worry about my little world to what worlds am I buying into, and then what do I need to be aware of in those supply markets and how they hand off to each other that I didn't have to worry about before. So I'll let my colleagues speak to other areas in that, but I'll leave it at what you gave me as a time slot.
Great, thanks. And I have follow-up prompts as well. But yeah, let's hear from Dr. Hanfield on that same topic.
So, I've been teaching procurement and supply chain for about 30 years now, almost as long as Bill. But one of the things that I see that's first and foremost is that procurement people continue to focus on cost. And cost is the thing that they are most often rewarded for. It's what they're measured against. And particularly in healthcare, they've gone offshore to low-cost suppliers because they were the lowest cost. And that increasingly occurred not just within healthcare, it occurred in the Department of Defense, it occurred, across our federal government and state government, et cetera. And no one ever really thought about risk. No one ever really thought about preparedness. And, the thing is, you don't get any credit. You don't see any value if things go right? You don't get any credit for being prepared when things go right. And the way that we monitor risk at both the corporate and the government level, and you look at the probability of impact and the quantifiable hit, you can reduce risk, but there's no emphasis on it, and therefore there's no reward on it, and therefore people didn't pay attention to it. And if you look at the event that occurred with COVID, and I've been working on the COVID crisis since early March. I was part of a team of people working at a federal level with the Joint Acquisition Task Force. And, we were talking to government agencies, state agencies. Nobody saw this coming. And what made it really terrible is that, first of all, and a lot of people don't realize this, is you had a double whammy. You had a virus whose epicenter was Wuhan, China. And at the same time, Wuhan, China is the epicenter of the PPE industry. So you had a deadly virus attacking a city where a lot of the PPE is produced, a lot of the healthcare med-surg stuff is produced, and then which rapidly spread and then which shut down every single industry. And that's what was unique about this crisis, is it impacted every industry, it shut down every supply base, and it occurred in every country. And the entire world shut down, as we saw, and caused a global recession. How do you quantify the likelihood of the risk of that? And that's what we have to figure out. We're not doing a very good job of that today, I believe.
Great, and that actually leads into our next set of questions here. So, and it's still on this same topic, and this is for both of you guys, right? So how are companies sort of monitoring and managing value chain risk? And what role do you see advanced technology like AI playing in supplier risk management? And sort of how do you see technology augmenting the early warning systems that may be in place?
I think there's some interesting technologies out there. I know a few organizations are using a product called Resolink. There's a few others out there as well. Supply chain or risk metrics, DHL 360 supply chain. So there's various platforms now that are looking at global events and then looking at suppliers that are within that circumference, and then broadcasting signals basically to the procurement team to help them at least become aware of the potential for problems occurring. The interesting thing about COVID is the first signals people didn't really pay attention to. They didn't really think about, this is a virus and it could spread. I'm married to a mathematician who understands population growth and what exponential growth really looks like. And her words to me was, watch out. She was going to the grocery store back in early March saying, we're going to stock up because this thing is going to hit us. And it's only
responsible for the toilet paper epidemic.
Man, we still have it stocked in a closet, but but no, absolutely. And I don't think people took it seriously though. And interestingly enough, people at the National Stockpile that I talked to knew about this early on in late January. and were pounding their fist on the table saying, we're seeing shortages of PPE, guys. We've got to get out there. And nobody listened to them, unfortunately.
Yeah, and same question for you, Bill.
Yeah, I think very early on, even before this hit, we mobilized internal continuity team to look at COVID probably in mid-January. And we were looking at it in three dimensions. One is how do we, we're a LNG producing company and critical because we have long-term contracts that we need to mitigate against force majeure. It's not whether you can sell something or not. It's just making sure you can live in the production to deliver your product for the long-term contracts. And because of that, we started to look in January on how we protected our assets and how could we continue to produce and deliver LNG around the world. So we hit 5 continents and plus 30 plus countries. How do you do that with all those different countries creating all kinds of one-off tariffs? I don't want to get ahead of myself because I know that's another topic, but all of them just reacting because there weren't too many countries that were very proactive around this. They let it go on, as was said earlier, until March and into April, and by then it was really too late. So all of the things, we started preparing for the fact that this could escalate back in January, and it allowed us to really put a lot of protocols in place to mitigate our own operations and to provide whatever we needed in the way of materials and services. So we began to store critical elements we needed to operate as early as January. First the plan, and then actually starting to stockpile critical parts of our supply chain. Since then, to be a little bit better into that, we've looked at, as I talked about, the 3 categories of finance, operational capacity, and then really logistics and supply chain into those supply markets and out of them. We're now monitoring that on a weekly basis to look at kind of what are our top critical supply markets or suppliers, and then monthly we look at it we've been doing it for about 4 months, so we now look at a 3 to 4 month profile of the criteria we've put in place based on a risk of low to critical. Where are each of our suppliers, and what about the supply markets that they play in? So we now have a good idea of where we're going and what we're doing with that, and that's a part of what we continually look at where we need to adjust our point of view that we put in place back in January and February based on how we see the markets evolving. And obviously, COVID is the major driver of that. The capital project investment expenditure is just another dimension that we need to try to manage. But COVID is clearly the primary driver about keeping up with the risk. And so we monitor our top 100 suppliers and the corresponding marketplaces that are critical for us to deliver product to our customers. And we're seeing 75% of our spend covered by that. And we have markets that 40% of our markets are in critical to high with 2 or 3 of the dimensions that we look at. And that's been pretty consistent. The critical ones are dropping, but the risk is we still have high risk around at least 7 or 8 of our critical supply markets. And so we have to continue to monitor that. And we're using different services and internal databases to get our head around and monitor that. But to me, that's much more data to help us make better decisions on adjusting our plans. But I see some of our earlier decisions not to go China with any sourcing of a $38 billion capital investment has paid big dividends for us because a lot of the issues other companies were having with Chinese-based products have not been as big an issue to you. Ours is much more around European suppliers and all the spikes in Spain and Germany and Italy, and those are all critical countries for us in order to get products to sustain our production. So I think that's really kind of the highlights of where we're going with the monitoring. In terms of the technology, I think we'll see us evolving into using the technology more to be proactive. So we'll be working over the next months and years to put in place more decision-making dashboards around all the different pieces of information we've created, spend analytics, with market intelligence, with supply markets categories, contracting, all the different dimensions of what we do is all going to be looked at And we want to enable our folks to be able to effectively respond to shifts that we see happening. And I think now it's historically heavily, but I see us really beginning to tap into a lot of forecasts. You see a lot more forecasts coming in now about what they think the impacts of this might be going forward, and you have to get into scenario planning, and I see us moving more into that over the next few years. I just don't see this, this is going to repeat itself. It may not be COVID-19, but I think this is going to be the new normal, and that we're going to get hit by a number of things we didn't expect before. And we're going to have to be able to mitigate that with better decision-making tools in my mind. But it's a mixture of AI and different robotics, and data usually is ugly and raw, and it doesn't do you any good unless you can categorize it and manage it in a way that's it's effective, and all of that is dependent on AI technology. And I think we'll do that through a partnership with a service provider as well as our own databases. I don't see we'll be able to do that within our own organization.
Yeah, absolutely. And, that sort of leads to sort of my piece here. So from the solution side, what we're working on with clients is really around exactly what you talked about, right? So getting away from the historical and more towards the predictive and the forecasting. So we work on a predictive sort of mind plus machine framework where we monitor supplier news and financials on a daily basis, score those items, and then put them into a quantitative framework to deliver an overall score. Right. And basically the way people are using this is when a supplier trips the risk alert for bankruptcy or even just severe disruption, the category team then can go ahead and take mitigating action. And that may be something like halting advance payments if they're not sure they're going to get the work, stockpiling at-risk SKUs, or, even sourcing alternative suppliers before the competition can sort of buy up capacity and drive up prices. But yeah, very similar to what you guys just described there. All right, great. So that is our first topic. Audience, feel free to shoot in questions on that, and we'll address those in just a minute. On to our next topic here, local versus global sourcing. Since we started with you last time, Bill, we'll start with you here, Dr. Hanfield. So we have seen the pandemic impacting buying channels. How it impacted sourcing strategies for companies in your view?
Yeah, so I think, certainly there's been a lot of discussion about, localizing the supply base, and we've had some discussions with the Chamber of Commerce in North Carolina a bit about, the possibility of building a localized PPE, industry in North Carolina, which I think can happen. The issue, of course, is, you can issue a DPA. The government can say that they want to localize that, and you can do it for certain categories of products and services. We actually did an interview with General Motors about how they deployed their ventilator system with Ventex. So they had all the designs. The designs were digital. They could deploy it across their supply base, and they could take some of their current suppliers that had injection molding capabilities and were able to rapidly, build to scale. They also used some additive manufacturing to create components, and were able to, I think they produced, several thousand ventilators in a relatively short period of time. Having said that, that doesn't apply to every industry. There are many industries where the supply base is in Asia or in China. A good example, we have an automotive manufacturer we met with who told us that there are 4 manufacturers of brake pads that produce 80% of the world's brake pads, and they are located in one province in China. So, the efficiencies that those brake pad suppliers in the low-cost commodity market, you're not going to find anywhere else in the world, and you're not going to be able to find someone that's comparable with that level of capability, et cetera. Likewise with electronics, you're not going to be able to suddenly move the entire electronics sector, which is largely based in Southeast Asia and China, over to the U.S. or over to other places. So it's highly unlikely that you can displace some of these industries. I think what will have to happen for those kinds of industries where you're not going to be able to shift a supply base is you're going to have to map out your supply chain. You're going to have to actually figure out where these suppliers are getting their material, and have better understanding of risk that exists across several tiers in a global supply chain. And most companies have no idea. When you ask them, who's your supplier, they have no idea. I met with someone who actually, the only way he figured out was he went to China and met with the supplier and told him who the second source was. He went to the tier 2 supplier and met with him, and then found out who the tier 3 was and went to the tier 3 in person. So literally, it's that level of scrutiny that you need to put on your supply chain to eliminate risk for those industries that are truly embedded in certain regions. Having said that, I think we're more likely to have some type of local platform sourcing by region. So, for instance, if you look at the U.S., Canada, and Mexico, Mexico has low-cost labor. Canada has lots of resources, and the U.S. has lots of capital. So, that could be a pretty powerful trading platform, if those three countries were able to, get their act together. And I know there's the Free Trade Act that just passed, but, start to build some better communication and better trade policies that would facilitate that. I think you could eliminate a lot of the risk. And a few companies have done that. Caterpillar sources most of their components in Mexico now, as opposed to India and China, because it's a day away. A lot of their people speak Spanish, and they can come and go as they please. So there's a certain benefit to being local. And the last thing I'll say is, with local, people are also often overlooking. They're focused on the P&L statement, so they're focused on price. What they should be looking at is working capital, because when you have something coming from a supplier that's on a boat for 3 to 4 weeks, that's inventory that's sitting on your balance sheet, not doing anything. So that cash to cash and freeing cash flow is another consideration that needs to be put into that overall total cost equation.
Yeah, absolutely. And Bill, same question to you before we move on to the other questions.
Yeah, I think, having worked in other organizations that are more mature and cost was king, I've been blessed with working in a company that grew from 2016 of being $1 billion company to last year being almost $10 billion company, and trying to keep up with the $38 billion investment in capital construction of 9 trains, and essentially bringing 2 trains on every year since I've been here. So ours has been production's king. What do we need to do to ensure reliability? And cost is now creeping in, but it is really, if what I've been asked to focus on is to ensure that production reliability stays and that we never lose that. And that is clearly 75% of my remit. How do I mitigate that risk so that we don't have to get caught with our inability to meet production demands? So what we see happening is, we didn't have the China issue, even though we've looked into some of the tier 1, tier 2, and 3 suppliers of some of our key suppliers and their feedstocks, and there is some China. Not as much. We're fortunate there aren't a lot, and they've already started to make shifts on their own to alternate markets to produce that product, so they've become a lot less China dependent in the last 2 years with us to look at alternate supplies. So what we've been looking at is, in all the critical supply areas, what can we do to have multiple places we can pull critical materials and services that we need? So on the services side, what I see happening is there is no such thing as an EU anymore. COVID and all the spikes that are happening have resulted in every country putting up tariffs, which are very nebulously defined. I'll get ahead of myself on the tariff. We'll just hold that thought and realize that whatever you thought the European Union to be is gone, that each country is protecting the health of their citizens, and that's driving a lot of bad habits. So what we've done is we've looked at materials, critical materials and services in the supply markets, and we've looked at our contracts, which is important, because what do your contracts allow you to do for the materials and services you have? So a little bit to what Rob talked about, where you have critical materials that are OEMs that are in Europe, you've got to have the right to take those specifications if they can't get you critical products, and be able to get agreement on a domestic company that can produce that spec if we need it in the case of emergency. And so how do you define terms and conditions that allow you to do those kinds of things? And we've already had a couple of those situations where we've had to do that, but we're now trying to create a more sustained set of supplier relationships that are mixed of local and regional, much more in North America than they ever were. And in some cases, that means due to the volatility of the market that we've got to have longer term relationships. So we've looked at the way we are sourcing everything and have changed the whole direction on how long we have contracts, what those contracts say in terms of materials and services parameters, and allow us flexibility to get specifications if required and go to alternate sources to deliver those products if there's their inability to deliver it to us in a timely manner. So we certainly have done a lot to reevaluate a lot of that, and I see over the next 12 months us to continuing 18 months probably to really solidify that so that we can provide reliability in production and at the same time look where there are cost savings. But I'm fortunate in this position for the first time in my career that 75% of my goal is reliability in production. It's not cost savings. Cost savings is being looked at, but that, it's anything in oil and gas. The cost and revenue from LNG will outweigh anything I might be able to save them in contributing to the assets. If I can increase their yield, which gets to more of the TCO models, that's more important to them than, if I save $3 on a widget, a well-used, abused word in supply chain vernacular. But I am fortunate that is their focus, and we have a plan that we're mobilizing around how we create the right relationships and where we source different things and how we deploy that over the next couple of years. And so the way we look at things will be very different. The triggers that allow us to reevaluate where we're going are very different. The frequency that we look at them are different based on the supply market categories. So it's good that our transformations evolved to the point where we're beginning to look at that and align ourselves to create category expertise in a fairly small company. Imagine you've got all the diversity of categories you have in a big company, but you got a small company. So you can't have a specialist for each of the different categories. You have to figure out how you bundle them so that you can effectively monitor and manage those things going forward. So size and scale does limit what we can do in terms of building category expertise and requires technology to enable us to fill the gap.
Yeah, absolutely. Sorry, go ahead. Anything else there?
No, I've kind of answered all three of them. And
yeah, no, you hit all the points there, and I'm glad you mentioned supply market analysis and TCO models, because that really emphasizes, right, like the power of external knowledge and, what it can do for you. The advice we give to clients really is around, making sure that you develop a comprehensive, forward-looking category sourcing roadmap. Because if you're proactively monitoring those markets on an automated basis rather than just doing it ad hoc as sourcing events come up, you can really take advantage of some of those tactical opportunities that present themselves. And I'm sure you guys are looking at right now, like in one category or another, maybe we want to sign long-term contracts here and sort of lock in these lower rates that are coming in through this more challenged market. And then there are other categories where, you need to maintain some flexibility, in case there are supplier disruptions or things like that. We actually had a client recently who was sort of facing the prospect of a major gas and fire panel replacement. And they had the thought that, given the downturn, maybe it would be okay to source it now because maybe the materials or the labor would be cheaper. And the vendor was certainly encouraging that view as well and, not very favorable to offering a retrofit rather than a replacement. And so what we did is using a TCO, total cost of ownership, should cost model, we're able to show them that a retrofit would save about $15 million and even achieve the same service life. And then using a supply market analysis, we're able to produce a qualified list of alternative vendors. And that basically gave the negotiating team, all the details they needed. They were armed with the right stuff. They were able to go in and, get the vendor to agree to the retrofit. So there's real world examples like that happening all across, this space of, how external knowledge can come in and make a really big impact. And as you said, right, it's more about, delivering value and, helping launch the operations, right, and make sure there's no operational issues rather than, saving $1 here or there on a given product.
Yeah,
good. I think
where applied that TCO and that multiple process is before we were addressing all capital improvement projects independently. And over the last 12 months, we've worked closely with our capital project teams to look at the portfolio of projects and what are the right suite of suppliers to support the complicated TCO lotting, and came up with a portfolio of suppliers based on the nature of the scope of work. And so where they were trying to deal with these on a one-off basis, we now have a plan in place that will allow them to do a portfolio of about 150 different capital projects in varying sizes that they can apply an existing base of suppliers. It also gives us the right labor skills, which is becoming a tight market now, and getting the right skills you need from different suppliers, because the suppliers know we're going to be working with them for the next 3 to 5 years. So that's probably a great example of something we just put in place, and it'll get us ahead of the curve of about $1.5 billion worth of capital improvement projects over the next 3 to 5 years, made up about 120 different projects. You can imagine how those different moving parts work in different parts of the organization, but that wouldn't have been possible without much more sophisticated ways of looking at things.
Perfect. So we had a couple of questions from the audience on that, but we'll get to those in the Q&A, because I do want to get to our next couple topics here. So the next topic is around digitalization and how it's being used by companies to solve these issues right now. So I guess we can start here with you, Dr. Hanfield. So in your view, what procurement and supply chain functions do you see adopting digital transformation the fastest or the soonest?
So, I would say that, the rush towards digitalization is well and good. And, I'm a big proponent of digitizing supply chains. The thing that I see is that has to come first, even before that, is data quality and data governance. And, I think we're seeing today that the data, most data in most organizations is terrible. It's full of errors, and, it's latent. We do an annual data quality survey at NC State, and we find on average people spend 2 or 3 hours every day just trying to find the data they need, to do their analysis. And generally speaking, what that involves is, going to multiple databases, pulling the data, putting it into an Excel spreadsheet, doing your charts, cutting and pasting those charts into a PowerPoint and handing it over to your supervisor. I mean, that's hardly what you can call digitalization. I think what we need to do, and we wrote about this in our book, The Living Supply Chain, and it was co-written with Tom Litton from Flex. And we talked about this concept that they developed called the Pulse. And the Pulse is a big room where you go to their headquarters in San Jose that shows their entire supply chain, 180 factories all over the world. And it shows all the material, where it is, its current status, whether it's inbound, whether it's outbound, KPIs for every SKU number, every product line, and it's all in real time. And you can see this in real time because it's essentially, and they have multiple systems across the company, but they've developed a system that is scraping the data from these systems, putting it into a control tower format, and then blowing it out over people's cell phones as well as this control tower. So you can literally see your entire supply chain on your mobile phone, and you layer on top of that event management issues, and now you've got events that are triggering discussions and collaboration around how do we fix this problem. So I think the idea is not so much just more data, it's what is the right data, and what is the right data that people need to do their job. What are the key metrics that they require at any given point in time to make decisions, and how easy can they access the data they need at that time. And it's more of a philosophical approach to designing a digital system. The data is only useful if you can use it to make better decisions. And you also need to have people, there's a skill set here that I like to call mental agility, right? You need to have people that are agile, that can look at the data and understand what it means and be able to translate it into actions, or in some cases be able to drill down and look for other data that may be related. So that whole human in the loop thing will continue to be really important as we move towards a digital future. But I think, you can't just have the IT guys designing your systems. You need to have, experienced business process managers, people with 30 years of experience saying, this is the kind of data you need to look at that's going to be critical to making this decision. And, I think that's where we're going to go. And again, the idea is it needs to be real time. I mean, you should be able to push a button. You don't need a PowerPoint anymore. You push a button and you see what's happening in your supply chain today, right now, at this very moment, and have a discussion about that. This notion of backwards looking data, spend analysis, or, KPI, order fulfillment analysis looking back over the last month, isn't very useful anymore. And it's not a technology issue, by the way, it's a leadership issue. Leaders have to create that vision. The IT and the technology people can deliver it, but you have to tell them exactly what it is that you want to do.
Yeah, absolutely. Great points there. Some I'll address here in a second as well. Same question to you, Bill.
Sure. The fortunate thing of being here and having 30 years of experience of trying to retrofit data governance and data quality on data that have been accumulated over a long period of time that became, you're talking about thousands, hundreds and hundreds of thousands of data that you're trying to retrofit and make useful. Here, in the first 3 years I was here, our primary goal was to give sanity to raw data, put governance around it, start to give standardization on the way we capture information. And that's what we've been doing the last 2 to 3 years. This year we've added the third dimension, which is much better visibility to the contracts part of this, which before we were in total reaction mode. So here we are 3 years later where we have the right data governance, the right categorization, and we can scale now all of those things into more of the decision-making tools, which is what we'll focus on going into the next 2 to 3 years. Because I'm a firm believer is you need to make the tool, the data available to people. They're not spending all their time collecting and aggregating the data and putting them in PowerPoints. They're actually looking at the data, making decisions, and then recommending solutions, not spending 75% of their time putting data together. So the goal going forward is, now that we've focused on data governance and quality, is that we want to create the right decision-making tools and people at really 3 different levels. One is the category teams, the other one are the sourcing teams, and then the fulfillment side of this. How do we look at all 3 of those dimensions and have the right data in place that we can slice and dice from different ways, and then lay over forecasting tools for the future around those same pieces. I think we've been fortunate enough. I got here at the right time before we created too much really bad data, got it in place, and certainly you guys have helped us. I remember it used to take us almost 2 months to get the data we need to pull together for the previous quarter, and now I think we're down to a week with the result of technology and the right data governance, great knowledge. When I got here, they said, we don't spend any money with anybody but Bechtel. So I had to sit in front of the CFO and explain to them we spent about $400 million with other people. That was not just Bechtel who was building the trains. And it's been a real educational process with having that information. Historically, forecast, we now have a 5-year model on demand of what we think we're going to have by category that's built into the budgeting system. So we've got the operations folks to agree to categorize the way they capture and forecast their budgets. So that's now down to 25 categories. It used to be maintenance. No one had any idea what was in maintenance. Now, we've got 20 categories that we work with ops to look at what their future forecast. And that model was created by us, with them not fully appreciating what it meant, but now it's something we use together to prepare what we need to do now. So all of our plans for 21, 22, and 23 are based on that forecast plus capital project expenditures. So by the end of next year, we'll have the ability to look at both capital and operating costs on a 5-year basis going forward. So having the bad pain of having to retrofit has definitely allowed me to come in here and get the right quality and governance, and we're scaling as the company grows rather than having to retrofit 100,000 records from all over the world and trying to make them fit.
Hey, Bill, I remember when you told me that when you told your boss how much they were actually spending versus how much he told you they were spending. That must have been an interesting discussion.
So we work in a company with financial people that are from the VC world, venture capital world. They're not operations finance people. So to me, having had 3 years in consulting and understanding how venture capitalists think, it was eye-opening to me that I could actually translate from people that knew nothing about operating finance to start explaining to them what finance is and what we were spending money on. That's the first of my career, but it's good because I had a lot of scars to, remember the days when I didn't have the upper hand and other people thought they knew more than you normally did know more than I did at some gross level. So it's a great place to be. So I definitely reinforce, if you ever get a chance to do it while you're growing rather than trying to retrofit it, because it's a lot more painful to do it the other way around.
Yeah, and thanks for your comments on the spend analytics and how we improved the turnaround time there. So that was really a story of RPA, right? So robotic process automation. And as you guys just mentioned, right, a lot of PSCM groups actually report up to finance. So a lot of those different use cases flow up, right? And you can actually use this to, enable predictive analytics on anticipated spend and capacity and sales and operations planning as well. And your points, Dr. Hanfield, about the data environment are really important as well, right? We've seen a lot of really sophisticated, huge global firms that are still sitting on, using Excel sheets, using multiple disjointed ERP systems to house their data. And there's a lot of, dollars of, insights and cost savings and time savings just sitting on the shelf that's available, for process improvement. Actually, we have a question from the audience here, which I think is germane to what we're talking about here before we move on. So what kind of ROI do you guys see being derived from supply chain control tower initiatives, and where's the best place to start on such a journey?
Well, I can talk to the case of Flex that I worked with, a couple of years ago when I wrote the book with Tom Linton. They were able to put together, the idea for the Pulse was basically on the back of a napkin. And, the technology itself isn't particularly expensive. Again, you got to create a data lake. You've got to take the time to figure out what data needs to be pulled from the different systems. Make sure that, it's vetted, because if the data's in there and people don't trust it, they're not going to use it. That data then is pulled into a control tower format and then is put into a mobile platform where different people can access it. The other thing they had to do is they had to designate what roles would look at what data. And it was almost like a LinkedIn type of format where you clicked on the data that you needed to do in your job. If you were a customer rep, if you were a procurement person, if you were a planner, what type of data did you need to manage that facility you were working at? And then those data feeds were created and became part of your own personal dashboard. The initial cost of getting the Pulse up and running in the first 6 months was under $1 million. It was more like this, $650, $700 range. In the first year, the big payback from the Pulse was the ability to see where inventory was in the system. And the ability to, look at that inventory and start to eliminate inventory in the supply chain. And they found there was all kinds of inventory. It was in receiving, it was in shipping, it was in inspection. They looked at work in process, they looked at finished goods, they looked at inventory throughout the entire end-to-end supply chain. And as a result of that, they were able to take out roughly 6 days of inventory out of that supply chain. For a company as large as Flex, 1 day of inventory is equivalent to about 50 million in components and parts. So they essentially took 300 million in working capital out of that supply chain in the first year and handed the CEO a check. That's a pretty good ROI. And I can't say that's going to be the same case for every company, but I think the key thing is it's going to drive efficiency, it's going to drive productivity, it's going to drive you to be able to see where the problems are. And the key there is to drive, it goes back to the old thing of lean. It's to drive flow. It's to drive material velocity. That's the real payback. at least in a manufacturing setting, for investing in control towers.
Great, thanks for that. Bill, same question to you. What ROI do you see, and what do you think is the best place to start?
Yeah, I think what the focus is, and you've got to, Rob, a little bit, is the focus is what can you do to make the business more efficient, not worry about just what is the cost to deliver it. So when we start to look at where we see the company moving, we look at where are the ways to optimize our delivery of our product. And so yields, production reliability has been something, since that was a focus in the company, we could identify opportunities from the information we were keeping, both historical and forward-looking, to start looking at where we thought there were improvements as in terms of the production reliability. So when you look at that part, the upside, which is again a partnership with the business, it's not just supply chain doing it, which I think is important. We drive the concept of collaboration, and we don't do things by ourselves. We do them collaboratively with our customers. But we both need to understand our perspectives and be able to go after it. As a result of that, the cost savings targets which we generated, we weren't asked to do them, are probably half of what we're generating in terms of value for the business, letting the machinery run more effectively, more efficiently. Turning the cycle times around on when we swap out critical materials so the downtime is less. We've been able to identify that through supply chain initiatives with business to the point where that's easily 10x whatever we do in cost savings. And so I think having information that allows you to do that and have those conversations and identify those opportunities as being business improvement rather than just cost savings. Not that cost savings isn't creeping its head into what I do, but it isn't what I lead when I talk to the business. And we have a pyramid that most of my people have ingrained in their heads. And the number one thing in the top of that pyramid is if we're not providing quality and service level to folks, cost is at the bottom of that pyramid. Cost is great, but it's not the big provider to the organization. And we've instilled that philosophy in the way we've engaged the businesses, and it pays dividends because of our corporate priorities, for one thing. So it's nice to be able to lead with that as the priority. The data just helps you enable to qualify or quantify what that means, and the business is willing to work with you on that. So yeah, I'd say it's easily 10x to whatever we can get out of projects. We're looking more at just a cost savings initiative, but more from TCO perspective. And I think that's the case in the 3 or 4 really big projects. It will take us years to get to cost savings that we got out of those 3 or 4 projects that were much more around business improvement or reliability related changes. So in my mind, it's kind of a no-brainer. You just got to get people past cost savings into ROI based on how do I make the business more efficient, and supply chain becomes an integral part of that. I think the benefit this year I saw for the first time is I gave my budget presentation, and of the time I had with the executive team, I wound up spending 70% of the time talking about supply market impacts on our ability to keep the business running, and very little time on what the cost of my department was or the cost of the materials that we get. Even though we touched on that, it was not the majority of the conversation. That's very rewarding to have that after 30 years of saying, okay, what did you save us last year, and what are you going to save us this year? It's a much more rewarding feeling from a supply chain professional perspective than it is in past mature organizations.
Yeah, absolutely. And you guys both brought up the point that, supply chain control tower can contribute to more than just cost savings. So we deploy a similar solution, right? And some of the use cases we've seen in client environments are things like, optimizing the hub and spoke delivery from warehouses to help with business continuity, right? So for instance, if you're, Houston has seen, a tough couple of years with major storms and hurricanes. So one of the things you might think about is, how much inventory should we keep at our, Gulf Coast sites versus an inland warehouse, right? And what's the inventory interchangeability from a business continuity standpoint? Sustainability is a big issue too, right? It can help you. Once you have all that data in place, you can really optimize your supply chain, not just on a cost basis and a turnaround time and, service quality basis, but also on an ESG basis. So you can see sort of what's the best way to optimize our supply chain, for minimal impact on the environment and to, improve our corporate ESG rating as well. Okay, so we have a few other questions here, and we're firmly into the Q&A session. So taking some questions from audience, let's see. How frequently should risk be monitored in a non-COVID situation? What should be the cadence for monitoring in a COVID kind of situation? So I guess the difference between, if COVID is to go away, how frequently should we still monitor risk, versus how we're doing it now?
Yeah, I can speak to that briefly. I think the analogy that I like to use is you should be monitoring it continuously. There are these third-party platforms. The one I've seen that's working is Resolink, and it's equivalent to kind of the warning signals on your car. You don't need to monitor your tire pressure, your oil pressure, your gas levels, etc., until something goes wrong, right? And when something beeps on your dashboard, oh, I got to bring it in, or I have to get the oil changed, or I've got to do something here. We can set up supply chain dashboards that do essentially the same thing. You don't have to. You can monitor everything through technology, through automation, and then when there's something that falls outside the specification limits or that falls outside the normal, course of activity, bing, you get a warning sign. You need to look at this, and so I think that's where we're starting to see these systems that can monitor what's happening in real time across your supply chain, and then provide you with warning signals. When those warning signals come, then you need to have people quickly come together and examine what it is that's going wrong. And what's important there, I think, is to have the right people on that response team. You want people who really are familiar with that situation, with that facility, with that technology, with that commodity, what have you, because the data that's coming in may mean different things to different people. An executive probably wouldn't know what that data means, but someone who's maybe working as a maintenance engineer or as a planner would look at it and say, wow, this is a big problem and we need to address that. And I think that's the value of having this real-time collaborative data is it enables people to come together and solve problems when there are these major events. Another example I'll touch on quickly is we're working with the National Stockpile to help them design their SNS 2.0, and they're looking at potentially a control tower technology that would monitor where their material is, but also the expiration dates on those materials, and making sure that they can continually turn those materials and make sure that they're being used or they're being turned appropriately. So I think these digital technologies can provide you with the right updates, and if you enable them the right way to provide you warning signals, they can do the monitoring for you.
Great. Another question we have here, can you comment on the deflationary and inflationary cycle in different categories as a result of COVID, and how are you rewriting the contracts based on that?
I'll let Bill answer that one.
Yeah, thanks. One, I think the reality is that COVID is just adding an accelerator to both deflation and inflation. I think the issue is not as much inflation and deflation as it is lead times and ability to deliver the services and new materials you need to do over the short term until COVID cleans up. But this whole move from global markets to local, to regional markets is causing, it started with COVID, but it's been, as Rob pushes more than I agreed with him initially, I think COVID has accelerated this whole concept about what's the right supply market to play in to give your business an edge and keep your business running. So I see that being important, that you are monitoring things in a way that allow you to give assurance that you can provide the materials and services. I think that's going to be a bigger priority to most people than inflation and deflation in the short term. On the long term, then you still need to look at that, and you still need to look at the risk factors. But I will be honest with you, those two pieces are less of a concern for me related to COVID than they are just being able to provide the materials and services at a reasonable rate to our people. Because in the labor market, the technical skills right now are at we have a technical skill gap that we need to be worrying about for skilled labor. So I want to make sure I have the right skilled labor to have that happen. So what are the risks I need to manage to do that? On the material side, I got to be able to deliver it within meaningful time without having to triple my inventories, because we know there's a operational capacity issue. So how do you build the right relationships that allow you to provide both of those things? Again, it's probably more what we worry about for what we do, but the inflation piece to me is not my concern as much as just making sure I can deliver what I need to make my assets run.
Perfect.
I'm not in businesses like retail, but it might make a big difference based on my past experience. So it's easy to say in my business where the margins are higher. It's probably a little more difficult if you're in a low margin business. So now, Rob, you're going to cover low margin businesses, right? Since you threw that one to me at the beginning.
Yeah, I'm not sure I think we're going to continue to see, this COVID crisis continue throughout the winter. I would agree with you, Bill. I think, access is going to be key, and I don't see a lot of inflation or deflation going on right now. I think the Fed is going to keep it pretty low. So I would agree with you.
Can we note this? Because we hit a low percentage on our alignment on certain things. I would like to put a mental note that Rob and I agreed on this date on this topic.
Yeah, I purposely didn't bring up smart contracts because I knew there was some delta.
Don't even go there. Do we want to just open it up for Q&A before you bring one of those conversations in?
Yeah, exactly, right. Just to set a bomb in the chat here. Okay, good. So I think we've addressed most of the audience questions here. I guess with the last 2 minutes, just talking about some key procurement trends here, supply chain resilience, digitalization, industry-specific deflation, et cetera. I won't go through all these, word by word. But just if you guys have any closing thoughts, in terms of like what companies should be doing. I mean, from our perspective, when we're deploying supply chain control tower, in client environments, as you mentioned, right, it's really important to get the input from the business unit and to get the actual operational leaders, input and buy-in on these things. Because if you build a massive data lake at corporate, it's not always a given that the business unit team is going to know about that, know how to use it, and actually use it. And the other aspect too is when you're doing your sort of data lake migration, there's sort of right and wrong ways to do it for each organization. For some organizations, it may be worthwhile to do a full-scale data lake migration. And for others, you may want to just bring in a tool to, drop some API connectors in and just connect the data where it is today, right? Even if it's in an Excel or, multiple ERP systems. All you're trying to do really is enable that advanced analytics, enable those use cases, right? And sort of get to the ROI that's sitting on the shelf. So that's sort of our paradigm, when we deploy things. Any closing thoughts from either of you guys on, what companies should be doing here and, how to sort of address these challenges before we close?
I think all of those are challenges, but you can't swallow the whole thing at once. So the first thing you got to do is do a risk-based analysis on where are my highest risks, and then try to figure out how you leverage these capabilities to get you there. And then you can, because if you try to use an adage, one of my old mentors used to say, you can't boil the ocean on these topics. So go after where your high-risk areas are to your business and integrate them over time to where you get into the lower, medium, and you may never get past medium, and that's fine. But it's got to be a risk-based decision on how you apply these capabilities into your organization.
Yeah, I would add, I'm not a big fan of the term supply chain resilience. I really prefer this idea that I've been working on called supply chain immunity. If you think about it, your body develops an immunity to unexpected enemies that are attacking it. And I think that's the way we need to think about that is especially really catches my ear is proactive scenario planning. I don't think companies do enough of that. And I don't think they think about, well, what happens if COVID rates go back up to, X and people have to start staying home again? Or, what happens if we have another shutdown? Where would we be hit? What's the kill shot in our supply base that would shut us down? I think those are the things you should be focusing on right now, because this COVID crisis is by no means over. We're going into winter. It's going to ramp up, and we're going to see those same things occur, unfortunately, until a vaccine comes out. That's my 2 cents based on what I'm seeing in the field.
Perfect. All right. Well, thank you so much, guys. We're at the end of our time here, but I think we've delivered some good content, hopefully, for our audience. Thanks, everyone, for joining us. The recording will be made available. If you do have any additional follow-up questions afterwards, feel free to shoot me an email. It's just kareem.kayani@valueserve.com, exactly as you see it spelled there. And have a great rest of your day.
Thank you, everybody.
Thanks, everyone.
Thanks to both of our speakers. Take care, guys.
Take care.